The silver paradox, when $6 trillion returns, but metal vanishes. Wednesday, February 4th, 2026, $6 trillion materialized back into precious metals in less than 48 hours, the fastest recovery in modern market history. But while you were watching the price chart celebrate, something else was happening in the vaults. 5.9% of silver vanished in a single day. 2 million ounces withdrawn from Comex, Monday alone. China's banking apps crashing from gold demand they cannot fulfill. Dubai buyers paying 15% premiums just to secure metal. Paper says recovery. Physical says accelerating shortage. And 50 governments just gathered in Washington to do something they've never done before. Both realities cannot be true for much longer. Welcome back to Silver Collapse Coming. If you've been following markets for decades, as I suspect many of you have, you know that the most important moves happen quietly, before the headlines catch up, before the crowd notices. This channel exists for professionals like yourself who prefer documented analysis over recycled hype. If that resonates with you, I'd appreciate you hitting that subscribe button, not because I need the numbers, but because it tells me there are still serious people who value substance over noise. Also, drop a comment below letting me know where you're watching from today. Are you in North America, Europe, Asia, or somewhere else entirely? I'm genuinely curious where our community of strategic thinkers is located. Now, let's examine what just happened in the markets, and more importantly, what the vault data is telling us that the price charts are not. Wednesday, February 4th, 2026. The precious metals market just staged the most violent recovery in modern history. Gold up 15.622% from Monday's lows, adding $4.74 trillion to its market cap in just 48 hours. Silver up 26% from the same lows, adding another $1 trillion in 2 days. Nearly $6 trillion materialized back into precious metals in less than 48 hours. But here's what the headlines aren't telling you. While $6 trillion flowed back into paper valuations, physical metal is vanishing from the system at an accelerating rate. The Comex Silver Depository report from Monday tells a very different story than the price charts. 2 million ounces withdrawn in a single day. 35,000 ounces out of Asahi. 1.1 million adjusted out of Brink's registered inventory. 400,000 withdrawn from HSBC. 1.2 million withdrawn from JP Morgan. Total registered silver now down to 103 million ounces. That's a 5.9% drain in 1 day, not 1 week. 1 day. The paper price is recovering, but the physical metal is leaving the system. These two realities cannot coexist indefinitely. In Shanghai, the situation is even more revealing. Silver futures open interest has completely collapsed. All the speculative hot money flushed out of the system. What remains are banks frantically covering short positions, with no speculators left to sell to them. They're trading their short positions like hot potatoes. And here's the detail that changes everything. During last week's brutal sell-off, when silver crashed and the financial media screamed panic, something extraordinary happened in the delivery data. Normally, only 1% to 3% of Comex futures contracts result in physical delivery. During this crash, that percentage spiked dramatically higher. Paper shorts found buyers who demanded physical metal. The crash wasn't retail panic selling, it was institutional accumulation, disguised as liquidation. Let that sink in for a moment. While retail investors watched their screens in horror, institutional players were standing for delivery, demanding the actual metal at suppressed prices. In China right now, banks are experiencing something they've never dealt with before. Gold purchase demand, so intense that mobile banking apps are crashing. People attempting to buy physical gold are being locked out of their own bank accounts, not because of technical glitches, but because the system cannot handle the volume. Paper price says plenty of supply available. Reality says, sorry, system overloaded. This is not a bug in the software. This is a signal that physical access is becoming constrained. In Dubai, buyers are paying 15% premiums above spot price just to secure physical silver. 15%, not 1% or 2%, 15%. When premiums reach these levels in major global trading hubs, the message is clear. Physical metal is separating from paper pricing. And in Washington, D.C., something is happening that confirms the severity of what's developing. Today, the Trump administration is hosting the inaugural Critical Minerals Ministerial. Over 50 nations gathering in emergency session to address China's dominance over essential materials. Vice President J.D. Vance, Secretary of State Marco Rubio, and top defense officials are not holding this summit because supply is abundant. Just days ago, President Trump announced Project Vault. a $12 billion strategic stockpile, specifically for critical minerals, $10 billion from the Export-Import Bank, plus private capital, creating a buyer of last resort, similar to the Strategic Petroleum Reserve, but for metals vital to defense, technology, and manufacturing. And silver has been officially added to the USGS 2025 list of critical minerals. This is not symbolic. This unlocks federal incentives, faster permitting, and priority status in national security strategies. When governments classify materials as critical and launch multi-billion-dollar stockpiles, they are not reacting to abundance. They are positioning for shortage. Ray Dalio, one of the world's most respected macro investors, just issued a stark warning. The world, he says, is on the brink of a capital war. So we have a paradox developing in real time. $6 trillion recovered in 48 hours, while vaults drained 5.9% daily. Governments declaring silver critical, while premiums spiked to 15%, open interest collapsed. While banks cover shorts with no one left to sell to them. Paper says recovery. Physical says accelerating shortage. Both cannot be correct for much longer. The recovery in precious metals pricing is masking what's happening in the physical infrastructure. And the vault data reveals a system under extraordinary stress. Shanghai Futures Exchange, negative 26,412 kilograms of silver in one day. Shanghai Gold Exchange, negative 11,295 kilograms in 1 week. These are not small adjustments. This is physical metal, leaving the Chinese exchange system, while the renminbi price of silver is climbing double digits. When price rises and inventories fall simultaneously, the message is unambiguous. Supply is tight, demand is real, and delivery matters more than paper contracts. The Comex registered silver inventory now stands at 103 million ounces. For context, global silver demand in 2024 was approximately 1.2 billion ounces. That means current Comex registered inventory represents less than 1 month of global demand, and it's draining at 2 million ounces per day. At this rate, without replenishment, registered inventory reaches critical levels in less than 60 days. But here's what makes this situation different from previous tightness episodes: the open interest collapse. Shanghai silver open interest has fallen to multi-year lows. Gold open interest in Shanghai extremely depressed. Historically, this pattern signals the completion of forced liquidation. All the leveraged speculators have been washed out. What remains in the market are physical buyers and short sellers desperately trying to cover, and those short sellers are discovering something uncomfortable. There's no one left to sell to them. During normal market conditions, this would trigger a short squeeze, driving prices sharply higher. But we're not in normal conditions, because simultaneously, major geopolitical stress points are developing. Japan's bond market is showing serious fragility. The bid-to-cover ratio for 10-year Japanese government bonds fell to 3.02 at Tuesday's auction, below last month's 3.3 and well below the 12-month average of 3.24. This reflects rising reluctance among investors ahead of Japan's snap election on Sunday, February 8th. A victory for Prime Minister Sanae Takai's ruling bloc could enable further fiscal stimulus, significantly raising Japan's debt burden. As a result, the 10-year bond yield has climbed to 2.26%, near the highest level since 1999. On Thursday, another critical auction of 30-year bonds is scheduled. If that auction fails, if yields spike further, it creates cascading stress across global markets. This is the carry trade unwind continuing to unfold. When Japan's bond yields rise, it reverses the decades-long flow of cheap yen into global risk assets. The initial reaction is risk-off selling across all asset classes. Precious metals get hit along with everything else, but then the safe haven bid returns. We saw this pattern during the recent crash and subsequent recovery. The question is, does Japan's bond crisis create one more wave of forced selling before physical shortage forces the final breakout? And there's another risk factor, still unresolved. President Trump stated, talks still going on with Iran. Translation, geopolitical tensions remain elevated. Any military incident triggers immediate selling, followed by safe haven flows. The volatility is not over. But here's the critical distinction. During previous volatility episodes, physical supply remained adequate. Premiums stayed modest. Vault inventories stable. Delivery delays minimal. This time, the physical market is tightening, regardless of paper price action. Dubai, 15% premiums. China, bank apps crashing from gold demand. Comex, 5.9% daily vault drain. Shanghai, open interest collapse to multi-year lows. These are not normal market conditions. Silver ETF demand has begun recovering. Historically, when open interest collapses to these levels and ETF demand stabilizes, it signals forced liquidation is complete. The selling pressure from leveraged speculators has been exhausted. What typically follows is a sustained rally as physical fundamentals reassert themselves, but we're also seeing something that's never happened before at this scale: government involvement in securing physical supply. 50 nations meeting in Washington to coordinate critical mineral sourcing. $12 billion project vault, creating strategic stockpiles. Silver officially classified as critical for national security. Federal incentives, faster permitting, priority in defense and technology supply chains. When governments move this aggressively to secure physical supply, they are signaling what they see ahead, and what they see is shortage, not in 5 years, not in 10 years. Now, the paper market trades on sentiment and leverage. The physical market trades on supply and delivery. For the past decade, paper has dominated price discovery. But when 50 governments start building strategic stockpiles, when premiums hit 15%, when vaults drain 6% daily, paper loses its pricing authority, and physical takes control. There's a principle in commodity markets that veteran traders understand instinctively. When governments start building strategic reserves, the shortage has already begun. They're not positioning for theoretical risk. They're responding to supply constraints they can already see developing. The Strategic Petroleum Reserve wasn't created during times of oil abundance. It was created in 1975, immediately after the oil embargo, when supply vulnerability became undeniable. Project Vault follows the same logic. $12 billion allocated specifically for critical minerals. Silver, now officially on the USGS critical minerals list, alongside lithium, cobalt, and rare earth elements. This is not ceremonial classification. This triggers specific federal mechanisms: faster permitting for domestic mining projects, tax incentives for production, priority allocation for defense and technology applications, and protection from foreign supply disruption. But here's the detail that reveals the urgency. The Critical Minerals Ministerial, happening today in Washington, includes over 50 nations. Not 5 nations, not 10, 50. Vice President Vance, Secretary Rubio, and defense officials are coordinating bilateral deals, specifically to bypass China's dominance. Side meetings with South Korea, India, Australia, Canada, and European Union representatives. The goal is mobilizing capital, speeding project timelines, and securing supply chains fast. When this many governments coordinate this aggressively, they are not planning for abundance. They are preparing for scarcity. And they're doing it while silver is trading at $90 per ounce. Think about that timing. If governments believed silver supply was adequate at current prices, there would be no urgency. No 50-nation ministerial, no $12 billion strategic stockpile, no critical classification. The fact that these mechanisms are being activated now, while price is still below all-time highs, tells you what policymakers see in the classified supply assessments. They see the gap between paper contracts and available physical metal. They see industrial demand accelerating from solar, EVs, defense electronics, and semiconductor manufacturing. They see mine production unable to keep pace, and they see China controlling too much of the processing capacity. Ray Dalio's warning about an impending capital war connects directly to this dynamic. In a capital war scenario, access to physical materials becomes more important than financial engineering. You cannot print silver, you cannot create it through monetary policy. You either mine it or you don't have it. And global mine production has been essentially flat for the past 5 years, while industrial demand has grown 15% to 20%, driven by energy transition and technology applications. The deficit was being filled by above-ground stocks, but those stocks are now draining. Comex registered down to 103 million ounces. Shanghai vaults, negative 26,000 kilograms in one day. SLV and other ETFs seeing renewed inflows as investors recognize the supply situation. But here's where the leverage in this market becomes truly extraordinary. Annual global silver production is approximately 1 billion ounces. About 70% comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Only 30% comes from primary silver mines. This means silver supply is relatively inelastic. If silver price doubles, it does not trigger a massive supply response, because most silver production is determined by demand for the primary metal being mined. Copper miners don't increase production because silver price rises. They increase production when copper price rises. Silver just comes along as a byproduct. This creates a structural supply constraint that higher prices cannot easily fix. And when you layer government stockpiling on top of industrial demand growth, on top of inelastic supply, the mathematics become interesting. If Project Vault allocates even 10% of its $12 billion to silver at $90 per ounce, That's $1.2 billion divided by $90 equals roughly 13 million ounces. That's 13% of current Comex registered inventory. Now multiply that by 50 nations building similar strategic reserves. Even modest government accumulation relative to available exchange inventory creates significant tightness. And governments, unlike speculators, don't sell when price rises. They accumulate and hold. This is why the open interest collapse matters so much. All the speculative froth has been removed from the market. What's left is physical demand from industry, governments, and long-term holders. And supply that cannot respond quickly to price signals. This is how structural bull markets begin, not with hype, not with retail mania, but with quiet accumulation, while government's position in physical metal disappears from the system. The paper price will eventually have to reconcile with physical reality. The only question is timing. We're now in a market environment defined by contradictions. $6 trillion added back to precious metals market cap in 48 hours. Yet vaults draining 5.9% per day. Gold reclaimed $5,000 per ounce. Yet China's bank apps crashing from physical demand they cannot fulfill. Silver up 26% from Monday's lows. Yet Dubai buyers paying 15% premiums just to secure metal. Open interest collapsed to multi-year lows. Yet short sellers trapped with no one to buy their positions. These contradictions cannot persist indefinitely. One of two things must happen. Either physical supply materializes, stabilizing vault inventories and normalizing premiums, or paper pricing loses its authority and physical markets take control. The evidence right now points toward the second scenario, because during last week's crash, something unprecedented occurred. Paper contracts found buyers demanding physical delivery at rates far above the normal 1% to 3%. This means sophisticated players use the forced liquidation to accumulate physical metal at temporarily suppressed prices. They didn't buy paper exposure. They demanded the metal. And now that metal has left the Comex system. 2 million ounces Monday alone. This is not rotation, this is withdrawal. When physical metal leaves exchange vaults and enters private storage, it removes supply from the price discovery mechanism. The remaining registered inventory becomes the marginal supply available for delivery. And that marginal supply is now 103 million ounces and falling. For context, global investment demand for silver in 2024 was approximately 330 million ounces. Comex registered inventory represents less than 1/3 of annual investment demand. If even a modest percentage of global investors decide they want physical exposure, the available supply runs out very quickly. But there are still risks that could trigger another wave of volatility. Japan's bond auction on Thursday could fail, sending yields higher and creating global risk-off. Iran tensions remain unresolved, with potential for military escalation. Bitcoin, currently trading at roughly 15 ounces of gold, down significantly from its November 2021 peak ratio, could sell off further if liquidity tightens. Any of these catalysts could trigger another forced liquidation, testing recent lows. But here's the difference between this potential volatility and previous episodes. Physical fundamentals are now much tighter. If prices drop again, the entities standing for delivery will likely be even more aggressive. Government buyers don't panic sell. Industrial users securing supply chain don't panic sell. Long-term holders accumulating physical don't panic sell. The weak hands have already been shaken out. Open interest collapse confirms this. So if we get another wave down, it will likely be shorter and shallower than the previous one, because physical buyers will step in earlier. The question for investors is not whether physical shortage is developing. The vault data, the premiums, the government actions all confirm this. The question is whether you want physical exposure before the paper price fully reflects physical scarcity, or after. History shows that by the time physical shortages become obvious to everyone, premiums have already expanded dramatically, and availability has already constrained. In 2008, during the financial crisis, silver paper price dropped below $9, but physical buyers couldn't find metal at any price near spot. Dealers were charging $5 to $7 premiums over spot. Some simply stopped selling because they couldn't source inventory. The paper price said silver was cheap. The physical market said silver wasn't available. Eventually, paper caught up to physical. But those who waited for paper confirmation paid significantly higher prices. We may be entering a similar divergence, paper recovering from forced liquidation, physical tightening regardless of paper price. If you believe governments are signaling accurately when they build $12 billion stockpiles and classify silver as critical. If you believe vault data showing 5.9% daily drains is unsustainable. If you believe 15% premiums in Dubai and crashed banking apps in China indicate real supply stress, then the current environment represents an accumulation opportunity. But if you believe Japan's bond crisis or Iran tensions or broader market volatility will create better entry points, then waiting makes sense. The data does not make predictions. It shows what is happening now. $6 trillion recovered, vaults draining, government stockpiling, open interest collapsed, physical delivery demanded during crash. These are facts. What happens next depends on whether physical shortage overwhelms paper manipulation. Watch the vaults, watch the premiums, watch government actions, not headlines, not sentiment, not Twitter speculation. Access is what matters. If you can't take delivery, you don't own anything.